Good afternoon. I thank Nagraj for giving me this opportunity and also the Solvent Extractors Association. Today my topic is about the overall commodities market outlook. So I will be covering the global macroeconomy, crude, oils, sugar. In the next 30 minutes that is given to me. Generally, doing the last presentation is a very tough thing because you have to keep on waiting, number one. And most of the people would have covered all the aspects of it. But I try to cover the same from the data perspective. So, in one of the private meetings yesterday, we were discussing about, that we should bring on and expose the industry to what are the AI/ML techniques that are actually coming in. So one such innovation I would suggest to Adil from Teflos is also, see, today in India there is a national education policy where they say that you have to create the content of education in asynchronous way. Okay, meaning everybody is busy in their own timing. They can't attend the class at a particular time. Similarly, in our conference, people are busy in their meetings, so they can't attend on the time that you have. So you should monetize this content by recording and then send this recording conversations on a subscription basis. Okay, so that you will be, people who are not coming here or people who have come here but not able to watch, you'll be able to capture that as a content. Okay, having said that, let me get back to my topic. Basically, the outlay of my presentation reflects our delivery website. Okay, this is our delivery portal where we cover the research and engagement. We give predictive analytics and prescriptive analytics. When I say predictive, what will be the prices? Okay, at various time periods, and prescriptive is how you should convert that particular price forecast into a procurement strategy or a trading strategy or a hedging strategy. And we also use a good amount of AI/ML analytics. Okay. We also have an app where you can get a lot of dashboards in terms of the market information as well as what we call as a PCS exim data, that is production, consumption, stocks, exports and imports. I am a great admirer of Ray Dalio. He is one of the, he started as a commodities trader and became one of the richest hedge fund managers in the world. He is in the top, I think he is in the top 20 billionaires in the world. So what Ray Dalio says is, he has been predicting that because of the high debt, the hegemony or the leading nature of the US economy will be challenged by the Chinese economy. So he has analyzed for the last 200 years and he has been talking about this particular crisis. So this particular multipolar tariff war, which we are witnessing now today in terms of the trade, technology and geopolitics, we should not be under the impression that the tariff war is happening because of the Trump has come. Okay. So don't make the mistake of thinking that what's now happening is mostly about tariffs. Okay. Tariffs is a result. Okay. Why somebody wants to increase the tariff? Okay. He's a very, very sound businessman, President Donald Trump. Why does he want to do? Everything what we believe is what he's doing is as per the common sense. Okay. It is not illogical, it is highly logical. Why? Because he is trying to address the concerns of fiscal deficit, trade deficit and trust deficit that people have in US economy. See, the fiscal deficit has reached a situation where, there is no other way but to bring it down. Okay. And as we know, every year because of the inflation, the expenditure increases and revenue will not increase to that extent, and that is where fiscal deficit for every country keeps on going up. Okay. So you have to keep on borrowing. Already US is having close to $35 trillion of debt. And I have to borrow close to $2 trillion debt every year. It is unsustainable. So he knows that one, and then he knows the problem of fiscal deficit. So to enhance the revenue, he wants to bring down the trade deficit. So he wants to collect more customs duty so that you will encourage the local manufacturing. So, and then we also have a trust deficit issues. So US generally operates when there is no scope to do further mistakes. There is no other way but to do the right thing. That is where that is the situation in which the Trump administration is. And before I dwell upon what are the fiscal deficit numbers, I want to highlight, what is the use of attending our presentation and attending the GLOBOIL. So you can see here, this is the price outlook which we gave. The pink line was the price outlook which we gave, and the black line is the actually happened. So when we presented in the last GLOBOIL, in the international GLOBOIL, we expected that the market will hold below 4,800 ringgit and then it will fall to 3,900 by April, May 2025. And now in Global Dubai, in the May 2025, we are there and market is below 3,800. So market has exactly moved the way we anticipated. Why? It is mainly because of the simple analysis, common sense analysis and analysis based on the data. So we were saying that the production for Indonesia and Malaysia will improve and global certain stocks will improve, which has actually happened. And B40 compliance will not happen because of the expected fall in the crude oil price. The most important aspect of being bearish on the BMP, when the market was 4,500, 4,800, was that the crude oil will fall and will not be able to sustain the biodiesel subsidies. And lower crude oil prices was one of the key assumptions which has happened. Now from here, how the markets are going to move, let's look at it. So first thing is, the fiscal deficit in 2024, US had $4,918 billion of receipts, that is income, and outlays is 6,750, that is expenditure. Out of 6,750, 1,078 is the interest payment. So 21.9% of their income is going to make the interest payment. So 6,750 minus 4,918, $32 billion is the fiscal deficit. So the government, whatever is the fiscal deficit number, they issue the bonds afresh. And today the interest rate is 4.5%. For next 30 years, they have to pay 90 billion to fund 2024 expenditure as an interest. So it is becoming unsustainable level, and President Trump understands that. And he also believes in Ray Dalio to some extent. And Ray Dalio has been telling that, unless we address this, you cannot change. That is why this time the US people have given a very one-way kind of a mandate that this has to be addressed. So in 2025 already we are seeing, because you can generally fiscal deficit doesn't go, except in that post-COVID year, doesn't go down. So he is improving 5.65 to the revenue, and the expenditure is increased only by 6,900. For 2026, the President Trump's target is to bring down the fiscal deficit to below $1 trillion. So he wants to increase the customs tariffs, he wants to increase by around $450 to $500 billion, and through Department of Government Efficiency and by cutting the unnecessary foreign spendings, which the United States government is doing, he wants to bring down the expenditure by around $500 billion. While it is idealistic, we don't know whether it will happen or not. So you are talking about bringing the fiscal deficit to below $1 trillion. What is the impact of it for the commodities market? If he is able to be successful in bringing the deficit down, dollar, which is now being sold off, which is very weak, will make a significant turnaround, basically. And the demand growth will be spectacular. So, with this thing, and he also wants to address the trust deficit problem. In 2022, when during the Biden administration, $300 billion of US dollar holdings of Russian government was confiscated. Okay, they just took the money because they don't know. Which has spooked all the countries in terms of the forex holdings. If I am having my dollar money and if the US president don't like, they will take my money. So they have been buying gold and selling the forex reserves. So he wants to make a deal with Russia and Ukraine, and he wants to probably allow that $300 billion go back to Russia by creating a demand for Boeing airplanes. Now they have been saying that with that money they will buy the Boeing aircraft, so that the United States company will get a benefit, and at the same time their money will be utilized. So this act of Europe taking out the Russians' investments and saying that I am going to give it to Ukraine is very, very hypothetical, and it has changed the total confidence of the monetary economy. So by increasing the tariffs, President Trump is trying to address this is the new norm in the United States. So they approximately if you put a general tariff of 10%, 220 billion or 200 billion dollars is going to add up to the income. So they will make 10% as a new norm, and they are forcing the suppliers. All the countries, they are forcing the suppliers to reduce the price. So whatever margins people in China, people in Vietnam, whoever are supplying, whatever margins they are forcing them to tear down the margins. And the suppliers are bringing down the raw material prices. Okay, if I am an aluminium, say I manufacture aluminium windows and I am supplying to US. So if my margin goes down, I want aluminium prices to be down. So this whole thing is going to bring down the commodity prices, raw material prices. They are going to put lot of pressure because United States is not such a customer which will take the increase. So the general belief is that this tariff will be inflationary. Okay, so which is partially true. So we are saying that we will see kind of a lowest economic growth in the year 2025 of around 2.8%, and is mainly the emerging markets will grow by around 4%, and overall world GDP growth will be 2.8%. But the very important point is, where the slowdown will happen. US may not fall into recession, as yesterday Mr. Chandrasekhar also was saying about this one. US Q1 GDP has come as minus 0.3, which is low, because when you count the GDP, you add up the value of manufacturing, value of services, value of agriculture, plus net exports. So your net exports are negative number because your imports have been sharp, because in March we have seen historically high imports. Why high imports? Because ahead of the tariffs, everybody imported ahead of the time. So because of that, the Q1 GDP came as a minus 0.3%, which is an aberration. Because mostly it's not because of the value of manufacturing, services or agriculture, it is because of the higher imports that have happened in the month of March. But for the whole year, we are not expecting a recession in US, but recessionary pressures will come in the key suppliers like Vietnam, key suppliers like China. So that is where we are. But there will be good opportunities for competing suppliers like India. There will be very good opportunities. So as we have already made a UK FTA, we will be making another FTA with United States economy also. Now, why low crude prices are important for the United States strategy is, if I am increasing the tariffs to address my fiscal deficit problem, it should not cause the inflation. So I want to approach this problem from the supply side. So I want to keep the crude oil prices downside. So it is a political commodity, the crude oil prices. They will continue to keep the crude oil prices lower by increasing the supplies. So you can see the inflation in January 23 from 6%, the inflation has been falling as well as 2%. So the market is fearing that it will go back to 2.83% in terms of the inflation, but may not happen because we have given three scenarios. Most likely, with the bearish crude prices, which are now fructifying, it will remain under 2%, and eventually the interest rates will come down and demand growth will be very good. By the time we meet in September in GLOBOIL, Mumbai, I am thinking that we will be talking about a positive demand scenario, and going into 2026, the world economy will probably go into a very good demand growth scenario. So with this thing, we have seen that because of the recessionary impact in dollar index prices of oil. So that is why rupee, USD FIR, Indonesian rupiah, everything appreciated. This is a very right time for us to fix our import prices, basically, because the dollar weakness is probably whatever is there, it has kind of come to an end. So what we think is it will temporarily go towards 102, and eventually the interest rates also have not fallen that much. So buy dollar is something which is clearly emerging. And MIR also, which is now at 4.23, may go towards 4.3. And IDR also mostly will be towards the depreciation side. INR we think is 83, 50, 84 is a kind of a quite good low. Okay, but it will not go and make a new high, but it will go up to 85, 85, 50. So if you are having imports, this is a good price to price. So keeping this in perspective, let's look at the crude oil. So crude oil, the production is increasing. Why? Because US wants to keep the prices lower. So the United States production is expected to increase to 13.6. Saudi also is losing the market share consistently to other countries. So they also have been already persuaded by the United States not to keep the production cuts more, and they also want to capture the market share, and they want to move towards 9.4. And demand wise, we are counting here the Chinese demand will be 16.6 MMBD from the last year number of 16.4. This is where the demand can go slightly lower. So overall, the August 2022 is the reference production for the crude oil, which is 42.33 MMBD. From there, they have agreed for a voluntary production cuts of around 5.67 MMBD, and they are still producing less than 36.74 MMBD. So, which is their thing. So, you can look at 2025, there are two scenarios. If the Iran talks also comes back into picture, then Iranian production, which we have assumed from 3.3 will fall towards 2.7 MMBD in 2025, may not happen in scenario 1. In scenario 2, they will continue to produce 3.3 MMBD. With that expectations, we are thinking that in 2025 there will be a surplus of 0.53 MMBD for crude oil, and in another scenario the surplus can go increase to 0.67. So overall we are thinking a $50 to $70 per barrel is the most likely scenario, where temporarily we are thinking until June, July, which is the driving season in US, there will be some recovery of the crude oil prices to 65, but eventually they will go towards between $55 to $50 per barrel in terms of WTI, or $55 per barrel in terms of the Brent. With low prices, you coming into the vegetable oil puzzle that what we have. So both in Indonesia and Brazil, the biodiesel mandates are going to be very costly to fund that particular thing. So keeping this in view, let's look at the numbers. See, I am seeing in the first chart the October 2023 to April 2024, what are the import volumes in India, and in the second chart, October 2024 to April 2025. So October to April, 2-year period we can see. So we have imported 4.84 million tons in October 23 to April 24. The same thing this year was 3.5 million tons of palm. So overall, we are seeing that around 1.3 million tons of palm oil consumption has been impacted as the demand has shifted to soybean oil between October to April. So approximately in 7 months, palm oil has lost 1.3 million tons of market share is what we are saying. So now, if we look at the Chinese, in China also around 400,000 tons is the demand shift from palm oil to soybean oil. So overall, from October to March period, the total soybean oil US has exported 610,000 tons more. Brazil has exported 140,000 tons more. Argentina around 0.89 million tons more in October to March of 24-25 as compared to last year number of 23-24. Whereas both Malaysia and Indonesia has exported less by around 0.81 million tons. And what are the projections from October to September for the whole year 24-25? The whole year we are seeing that the total palm oil imports will, the total palm oil exports will be flattish at 0.07. It means from May, June, July, August until September, this minus 0.81 has to come to plus. Okay, has come to plus. So because of that, and that can happen only with the lower palm oil prices. Today in India, palm oil price is around 1,200 rupees per 10 kg, and refined soybean oil is also at 1,200 rupees per 10 kg. When the palm oil prices fall to 1,100 rupees per 10 kg, which is around another 8% fall, in terms of dollar per ton, around $80 per ton. That is when they will be able to buy into the export market share. So we are looking at 1,100 for olive and 1,160 for refined soy oil, and 1250 for chicken mustard oil, and 1300 for refined sunflower oil price as a price which will actually drive the markets, and slowly sunflower oil also will lose the premium as we get the new crop numbers into picture. So that is where you will be able to export more quantities, and that is why we have seen that in Argentina soybean oil minus Malaysian olein, which was at a negative, which has now come back towards $52 per ton. So the strategy which we last time recommended to our clients, that sell BMD by CME, which has substantially given out almost $120 per ton of profit basically. So even today also we are thinking that overall sell BMD by CME will continue to work, but it may not be that kind of spectacular profits that what we have told last time. So the main problem is the Indonesia is going to increase its production by 3 million tons, and Malaysia is going to increase the production by 300 to 500,000 tons. So the incremental 3.5 million tons of farm production that is going to come, but exports are not increasing. So if we look at the quarter-wise breakup of the B40, in 2024 JFL, that is January, February, March, the biodiesel consumption in Indonesia was 3 million tons, and their target was to reach 340, which was 3.4 million tons. But what has exactly happened is 2.2 million tons only. So they have done below the 3 million tons. So, and AMJ, we are thinking that one scenario they will probably be able to do 2.8, which is B34, and 2.5 is another scenario. So overall, if we count one scenario, we are saying flattish. Last year number was 12.18 million tons. Scenario 1 is 12.39. At best, they will be flattish in terms of the biodiesel consumption for 2025. In another scenario, we are talking about is 10.4 million tons, where in that case, that will build up the stocks for Indonesia. As of now, we are thinking that by increasing the exports, the 3.5 million tons of incremental production has to go into the exports only, for which they have to discount at least by 5 to 8% compared to soybean oil price. That is the key thing, and that is why the markets are falling. So that is why BMD is looking to probably fall towards 3,500 to 3,600 ringgit per ton to buy the market share at the destination. So we are thinking that the stocks in Malaysia, which by April end are expected to be 1.73, they will slowly improve towards 2.28 million tons by September, and the stocks in Indonesia, which are around 6 million tons in April, they will improve towards 6.95 million tons. This is assuming that there will be flat biodiesel production. In case if the crude oil prices continue to, they make a deal with Iran and everything becomes hunky-dory, and the crude price falls to 50 from the current levels of 65 or so, then you will have a second scenario materializing where the Indonesian government already has a low balance in the BPKTS fund, and they are not able to increase the levy to cover that. They are not able to increase the levy. So I can't increase the levy if I want to gain the market share. So that is why there is one scenario, it can go further bearish from 3,500 ringgit to 3,200 ringgit, but as of now we are not looking at that. As of now we are thinking that around 3,500 to 600 by July for the BMD is the price that we should look for. Then what are the bullish factors? One major bullish factor that is developing is the US market, which we should all be aware of. Whatever I have told, I know that many of you already know it, basically. I just added the numbers and told. Now what I am going to tell you is going to add value for your investment for coming to global right. What is that? That is the USA biodiesel dynamics. So if you look at there are three important pieces in the US biodiesel program. One, renewable volume obligations, where the government gives some an obligation for the industry to meet, and then they give the tax credit, and which actually influence the rate prices. And then if somebody is not blending, the small refineries goes and apply saying that I have not blended the biodiesel as mandated, but please give me exemption. Last time Trump administration has given a lot of exemptions, because of which the markets in CME was bearish. So if US has exported 610,000 tons more than the last year, it means there is no demand locally. But things can change. Why? Because if you see this this chart, the biodiesel mandate in 2024 was 5.45 million tons, and the mandate was 107% fulfilled. But in Q1 of 2025, that is 5.95 million tons is the assumed consumption for the soybean oil. But that if you divide it by 4 quarters, that is 1.49 million tons. But only 920,000 tons or 0.92. Only 62% of the biodiesel mandate is fulfilled in the Q1 of 2025. While this is bearish, but what is happening going forward is, today, if you see the RIN value, this is from our dashboard in terms of the biodiesel dashboard. Here, you can see that the diesel price is $657 and CNA soya oil price is $1,082. So the renewable diesel cost is $1332. So there is a negative margin of $674.76. But the RIN value has increased to 610 from almost 229 in Jan to March. You can see the table last particular row, Jan to March 2025. The RIN credit was 229. Now it has improved to 610 because when you are not blending, my RIN supply goes down. Then that will, but if the demand comes up, I have less RINs, which will increase the price. So now Trump administration during the election campaign has told the corn and soybean farmers that we will support you. So this time he told that the traditional petroleum players and the biodiesel players to form a combined association, which they have done. So they have formed a combined association because companies like Phillips 66, the other traditional petroleum players have come into the biodiesel in the United States. So they have formed the association and they have given a representation to government that in 2025, the biodiesel mandate is 19.84 million tons, which is the second column you can see in the first graph. The BBT in billion gallons is 5.95 billion gallons is the government mandate. 5.95 billion gallons is 19.84 million tons. Out of that, 6.15 is soybean oil usage, 1.15 million tons is canola oil usage, and used cooking oil, which is nothing but indirectly palm oil exports from Malaysia, Indonesia to China, and which gets eventually exported to the United States, is 3.81 million tons. That is the assumption. But in 2026, if you see, in both scenarios, the association is expecting that around 8.23 billion gallons will be the mandate for 2026. So the decision of that will come in the month of June. So from 5.95 directly to 8.23, which is from 19.84 million tons, we are talking about 27.42 million tons for the total mandate. So that will increase the soybean oil consumption from 6.15 to 6.97, which will make the markets potentially bullish. So while all the supply side factors are bearish, crude oil prices are bearish, but after prices reach certain level, what might actually take the market back is the potential biofuel mandate in the United States, but we don't know whether it will happen or not. But if you look at 24-25, the oil stocks as of now are expected to be 0.68 million tons in United States. But if the mandate doesn't come, the stocks can sharply increase by September to 0.91 million tons, which can be bearish. So this is like a kind of an underbar. We don't know what exactly will happen. If the mandate comes, it can turn the market to bullish. Otherwise, it can be bearish. So whether Trump will give that mandate or not, we don't know. But if for the traders who wants to see the fundamentals, I want to say that today in 2019, the global soybean stocks were 111 million tons. Today, in 2025, global soybean stocks are 117 million tons. So what was the average price in 2019, which is today, is what I have in the first graph. So at the first graph, there I am saying that in 2019, soybean prices were $331 per ton, and now they are at $318 per ton. So the mean prices, soybean was 331 and now 318, bean was 346 and now at 377 in 2019 versus this one. Next thing is the BMD CPO average price in 2019 was $746 per ton. Today it is 907, okay, which is the green line. Then Argentina soybean oil, that time it was 828, today it is 992. So beer and meal have reached 2019 equilibrium level. Will they reach 2019 level because of the bean stocks? If there is no new biofuel mandate, then in second half of the year, during August, September, there is a potential for one more bear market. Okay, but most likely because the mandate might come, we are thinking that another $80 to $100 per ton fall is what is imminent. So PMD we are looking at 3,500 now, and then slowly market going up. And olein we are looking at 880 to 900 FOB Malaysian olein will be 880 to $900 per ton in by around July. And CME soya oil we are thinking around 46 it will take support, and then they can further rally because of the biofuel mandate. And Argentina soya oil we are looking at a price of around 950 as a FOB, 950, and from there slowly it will recover towards 1050. But bean stocks are quite high. That is the fundamental which we should keep in mind. Now, that is my view on the oils. And with your permission, I will briefly discuss about the sugar. See, the sugar production is going to be for 24-25 years. I generally take 9 countries major production as an important fundamental. So Brazil, India, Thailand, European Union, China, Indonesia, USA, Australia, and Pakistan. These are the countries that I consider as a major price driver. So this year overall production is going to be lower from 133.4 to 126.1. And that too, if you see from the Q2, it is kind of a similar. In Q1, the deficit was around 4 million, and Q2 from 41.3 to 39.1. Going into Q3 and Q4, that is AMJ and JAS, year on year, it is going to be lower production. It is going to be lower production. But because of the lower crude prices, we are having a lower price. So in terms of the Brazilian mandate at Dubai, which is $460 per ton is the sugar, sugar prices, whereas the Indian prices are at $490. So there is a $30 per ton kind of. If the global market goes up, then you have the opportunity. That is why we are thinking Indian exports will be around 0.8 million tons instead of 1 million tons. That is actually mandated. So overall, this year we are saying that an estimated for 24-25 year, around 3.5 million tons of sugar and 17.4 million tons of grains are likely to be diverted for ethanol making, which is going to give us this 800 billion liters of grain-based ethanol and 2.99 billion liters of sugar-based ethanol going into 25-26. So overall, we are saying that the exports, as of now, we are assuming 25-26 will be zero from India, and the sugar stocks at the end of 24-25 will be 4.2 million tons, which is substantially lower. And the stocks will continue to be lower in 25-26 to around 4.7 million tons. So this is our Brazil, Thailand, and India balance sheet. So as I said, from 23-24 stock number of 8.1, 24-25 sugar stocks will be falling towards 4.2, and next year also we are not expecting a major increase because we are expecting that Indian sugar production will be around 30 million tons. Gross will be 34, so 4 million tons will be converted to ethanol, and 30 million tons will be the Indian sugar production. So because of this flattish number, overall we are not very bearish in terms of the high sugar prices. I think technically we are low, but mostly I agree with the panel in terms of our technical point is around 16.6 on the downside. So the downside high sugar prices will be bearish for next 1 month between 16.6 to 17, and then slowly market will go up towards 19 by July 2025 is what we are expecting. So with that, talking about the sugar, so I did mention about the countries shifting their forex reserves from dollar to gold. So I just want to give 1 minute fundamental view on gold and 1 minute fundamental view on silver. So this is a gold balance sheet because Kailash has given me a broader topic of commodities. So I am just taking the liberty to talk about gold. So here the total supply in gold for 2024 was 5076 tons. So generally, I match the supply and demand number. The last line, if you look at OTC and others, that is the balancing number. So here, the central bank demand, which was at 1082 tons in 2022, by 2025 it is coming down to 800 because you have high interest rate and Trump is resuming the confidence. So because of that, the last 4 rows is what we have to see for the annual balance sheet. So we are saying 800 tons will be the central bank buying. So the surplus which was in 2022 was only 53 tons is now going to the 657 tons. So it means price-wise we have almost kind of reached the peak for the next 1 year for gold. So there is not much upside for the gold because fundamentally it may not fall sharply, but it will be kind of a range form. What we say is third wave peak is placed, we will be in the corrective structure. But if you look at silver, from 2019 onwards, overall market balance is negative. Because the industry demand in silver, which was 524 million ounces in 2019, is increasing to 767 by 2025, mainly because of the electrical and electronics and solar panels. So the industrial consumption is almost 50% in the total silver demand. So that continues to increase, whereas the mine supply is not catching up. That is why you have 275 million ounces deficit in the year 2024, and going into 2025, the deficit will further increase to 280 million. So if you want to be invested in the metal, you do 70% silver, 30% gold, which will eventually give you good return. So silver continues to be bullish, but gold will kind of taper off. So with that, I thank Mr. Kailas Singh, Atlas and Southern Textiles Association for giving me this opportunity. Thank you.
Thank you so very much, Mr. Nagraj, Meda. Indeed, what a fabulous informative presentation. And now I'd like to take the pleasure of inviting Mr. Abdul Fatubedi, sir. Will you please join us up on stage? And we request Mr. Abdul Fatubedi, sir, to please present a memento to Mr. Nagraj, Meda on behalf of everyone gathered here. This will be the final memento presented at GLOBOIL International, and we deem it appropriate that we have you up on stage to do that. Thank you so very much, sir. And ladies and gentlemen, please to join in with a nice warm round of applause. Thank you once again, sir. Thank you once again, Mr. Nagraj, for that fabulous presentation. Ladies and gentlemen, before the next session, which of course we are all looking forward to, the final session always at GLOBOIL India or GLOBOIL International, which is the Global Vegetable Oil Price Outlook 25-26, to be done by none other than Mr. Gaurav Mistry, Director, Goldridge International Limited. We have some very important announcements to make. First of all,